Okay, good. Welcome back, everybody. Yeah, Steve, I've heard that, and I will make sure if there's any questions, we will keep you informed. All right, we're here with David Weiss for the third part of this event. It's going extremely well here in Chicago, and for those of you on the internet, I hope you're enjoying it. We've got 2 more sessions here today. Going to be finishing about 4 p.m. here in Chicago. Now, the first session is with David Weiss. I know a lot of you have been looking forward to this. David's going to be talking about the Weis wave. David invented the Weis wave. So, and we were talking earlier about how many years experience each of us have, and because David, by far here, has exceeded everyone with 41 years trading experience in the market. So, somebody here who knows the markets inside out. So, without further ado, what I'm going to do, we're going to set David up with the headset here, start the recording, and we're ready for part 3. So, let's go. 3, 2, 1, record. All right, welcome back, everybody, to part 3, the eagerly anticipated part 3 with David Weiss, the inventor of the Weis wave and a market analyst for 41 years, so a man of great experience. And certainly, when you put the Weis wave together with volume spread analysis, you start to very clearly see, without any shadow of a doubt, that the markets are moved by the principles that Wyckoff taught us all those years ago. Now, we talked earlier with Tom Williams, and I'm going to be with Tom in a few weeks, which I'm very much looking forward to. But I've been trading with David and with the Weis wave, and have had great success trading the E-mini, the S&P, using his system. So today, David's going to spend some time with you explaining the principles, going through some charts, and I'll be helping David to move the charts forward. So without further ado, let me get David set up with the headset, and we'll get underway. Can you give a warm welcome, please, for David Weiss? Sound check for me, can you? Just say, can you...
Checking, 1, 2, 3. Can you hear me? Can't hear me. Checking, 1, 2, 3.
Okay, if you stand up a bit closer. Right, just get you set up here. Okay.
Hello?
Try that.
Hello?
Yeah, that's it.
Checking, 1, 2, 3. You hear me?
Oh, yes. Put it up a bit, Richard. That's fine.
All right.
All right. It's all yours. And
Okay. As I've said before in some of the webinars recently, I started in this business in 1971. I'd been an English teacher, a professor, and then a teacher working on a PhD dissertation down in Louisiana in a high school. And a friend suggested that I spend the summer working in the research department of a commodity brokerage house, which I did. And I found it interesting and much more lucrative than being a teacher. So from that point on, I stayed in it. And my first task in this department was to make charts by hand. I need to stand up here, and this is making me bend down.
okay.
Great. Is that it?
Yep.
Okay. So I had to make charts all day. And my eyes had to look at this very small grid on a piece of chart paper. And I used a fine point pen. And I used a razor blade to scratch off any errors that I made without tearing a hole in the chart paper, which was great fun. And the first lesson I learned about trading, all the people in the chart room were women except for me. And the head of this chart room was sort of a little battle axe. She was a wife of the partner of the boss of the firm, so she had clout. And she taught me right off that when you have a market that moves off the top of the chart, that's a sell signal. Well, obviously that's not true. It can go a lot higher. But that was my first lesson. I was making charts, and I was updating charts. At the end of the day, we had these large books, like ledgers, that were filled with charts, handmade charts, bar charts, dailies, weeklies, hourlies, point and figure charts, and we had to update them with the latest that day's price action. And I would look at these charts, and I would try to think to myself, how do you figure out when to make a trade? By looking at these wiggles on the chart page. Well, I was fortunate in that my friend who got me this job started funneling to me some books to read. And of course, the first thing he gave me was Ralph Newton Elliott's The Elliott Wave Principle. And I was all excited about that. I was sort of like the guy in Thus Spoke Zarathustra. I'm walking around, have you heard of Fibonacci? This was such a magical thing to me. I would go to a bar or a cocktail party, and I was drawing the relationship of waves and their Fibonacci relationships and their cognates and on and on and on. But I still didn't know how to know when something was poised to go up or down. So one of the things that I observed, and I thought at the time that it was my own creation, not having read much anyway, I didn't know if anyone else had written about it or not. I guess they have. But you look at this first hourly chart, which I've scrunched up intentionally, and you look at the volume. This is an hourly chart of U.S. Steel. And what stands out to you when you look at the volume? Anyone want to venture a statement, a guess? What? Yao Ming, someone says. Well, there is a bar on there that has the height of Yao Ming, that's for sure. That's one observation. Any other observations? It's hard to discern on this chart, but the first, pardon me? Someone has said the volume is clustered. Well, that's sort of true too. But notice that you have a large bar followed by several small bars and then another large bar. And this is what I called the U-shaped pattern of trading. That the biggest part of the trading activity of the day, as you all know, was in the first hour. And from that point on, the volume slackened down. And then sometimes on the close, there would be a bit of a crescendo of volume associated with market on close orders. Now here the little spikes are all on opening hours. This looks more like a ski slope. It goes down and out like that. It doesn't have a U-shaped pattern exactly. But I noticed that there were aberrations, that's what I call them, aberrations in that pattern. Let's turn to the next chart. This is U.S. Steel hourly, not exactly the same days that we were looking at on the first chart. And you'll see that I have two bars. I had someone develop a little indicator for me in TradeStation that would point out when the volume in either the second through the 7th hour was greater than the first hour. And so you see on February 28th, February 8th, excuse me, you see that the volume in the second hour, where I have that red arrow, is larger than the volume in the first hour. Now sometimes these so-called aberrations were the obvious, and sometimes they meant nothing. But every now and then they reveal something that was useful. And in this case, of course, you can see that the market has moved broke underneath this level of support with widening price spread and increased volume in terms of its relationship to the first hour's volume. And that marked the beginning of this slide. Over here to the right, we have another instance. There's only two on this chart. Right here, you see the market goes above the previous high, and I would draw a line across that high, left to right. And notice that the volume in the second hour is larger than the first. I have a blue arrow associated with that. And notice the position of the close on that day, on that hour. You see it's well off the high. And all of that effort to go up and not much reward, that was telling me that the market would be vulnerable to turning down. And if I want to get the edge, I could actually consider going short and putting the stop very close and seeing what would happen. Let the market prove me wrong, if it can. So that's one of the first things that I started working with. Then the next thing is this is bonds. I don't remember what year it is, but I made a volume profile. Across the top of the chart, you see the numbers 1 through 7. That referred to the day section hours in bond trading. And this was tick volume, not actual volume, because in those days we didn't have actual intraday volume. And then, of course, this is the individual days. And so wherever you see a red number, that's showing that the volume in that period is larger than the volume in the first hour. So that was a horizontal comparison. I'm just trying to show you how what one can come up with sitting before the market all day and trying to figure out something. And I spent a lot of time in front of the market because I became an analyst shortly after leaving the chart room, and I had to study the market all day. The next comparison I made is I decided to make a circle whenever the volume vertically, like in the second hour, was the heaviest in 5 hours or more. And the first time we had the heaviest volume in 5 hours was right here, where I have that circle. And you'll notice that sometimes you'll have a circle and a red number in the same time slot. So I thought I was getting somewhere. Let me show you where I got to. This is not on my old charts. This is a more recent chart. And you can look at it at your leisure. It's minute information to read off the screen here, but you all have a copy. And I have a table up here that explains the symbols. But I was able to derive a lot of information about changes in behavior. Seeing where you had the largest up bar. I also started comparing the size of the hourly ranges compared to the first hour through the 7th hour. Did that as well. Anyway, I won't go on this any further. But the next thing that happened, I had a client who was making a great deal of money. And he was trading on a long-term basis, trading for capital gains in the futures market, something unheard of. 6 months in a day. We were allowed to do that in those days, in the early 70s. So, as I was telling someone at lunch today, positions right now in sugar, for example, would be established in July 2013 if you believe that there was enough preparation for such a large up move. All right, but I took the Wyckoff course. This man told my friend and I that he learned to trade from the Wyckoff course, plus some extra tutoring. And he paid for me to take the course, and I also had some extra tutoring. And then he came to town and shared a lot of information with us as well. And then I took the tape reading course. Well, actually, I didn't take the course. Someone sent me a copy of it. And this is what opened my eyes. This is where I began to learn. This is a tape reading chart that Wyckoff created. This chart shows the price movement on one day in June, I think, 1932, is it? One day. And he's showing every 1/8 point fluctuation. It's structured like a point and figure chart. But instead of showing X's and O's, he plotted the volume in hundreds of shares in each square on the chart, the grid. And he wrote a whole description of this chart. And you can see certain principles. You can see how the market had a great deal of effort on this upwave. If you add up all these volumes, I think I put the number there, 41 or 4,900, as it takes out the high. But what about the reward for all of that effort? That's what something is wrong. There's too much volume with too little gain. And then the market comes back down and it finds support, and it goes underneath the support in what could be a spring. But when it tries to rally, notice how low the volume is. And from there it turned down. Well, I was very fascinated by this chart and all of the examples of other market situations in 1932 that were included in the tape reading course. So the next thing I did is I wanted to apply this to futures. So this is a bond chart. And bonds trade, as you know, in 30 seconds. In other words, and what I did here, I didn't show the volume at each price. I showed the volume for each row, or what we could call wave, or column. But let's call it a wave. And so you see that the first wave of the day is very large in reaction to something overnight. See, I can't see the screen here.
Oh, okay, no problem. There you go. How about that?
No, it's no good. It's no good. Oops. So you have a lift off with a lot of volume. You have a low and you have a rally. And then notice on the last pullback, there's not much selling pressure. And then came a bullish report that sent the market straight upward. Market reacted. The wave size on this, I'm using a minimum of 330 seconds to reverse the direction. It's like a 1/3 point and figure chart. And notice that the next up wave has much less volume, and the next up wave is not very large either. And then suddenly we have a pickup in volume right here. In his tape reading course, Wyckoff made a very astute remark. He said, and this was for his time, the market will change its direction 2 or 3 times a day. And here's how you tell when it's about to occur. In an uptrend, when the buying waves begin to shorten in length and time and volume, and the selling waves begin to increase in length and time and volume, you know that the sellers are gradually overcoming the buyers. Any questions about that? You understand?
There's a question up here, yeah. What do the numbers represent? Because several people don't know what point figure charts are. They've never seen them.
I see. Well, the question is, what do the numbers represent? The numbers represent the amount of volume on each of those columns or waves. That's what it represents. The numbers have nothing to do with it being a point and figure chart. A point and figure chart is just using a certain, usually I use a minimum fluctuation, as in this chart, 1/32. You can see that there are 8 30-seconds from this low to this line. So each increment is 1/32. And I'm using a 3/32 to reverse the direction. You won't see anything on 2 30-seconds or 1 30-second. It can be 3 or 4 or 8 or 20, but it has to be at least 3. All right. So you can see that the force of the buying is lessening and the force of the selling is increasing. And right here, you see we have a very overt change in behavior with a lot more selling. And then the market has one more gasp up. And notice the character of the demand or the buying on that rally. It's quite low. And from there, we have a huge downwave, the largest downwave on the chart up to that time, the heaviest amount of volume. You can't see how much time elapsed on this chart, but you can see the distance of the waves and you can see the volume. And from there we have a rally, and ultimately the last high is single digits, and the market goes down. And again you see the large volume, and then the small demand on the corrective rally, all the way down to the day's low, where we're beginning to see that the selling pressure is starting to slacken. But this is one day. You can take a point and figure count. You can take the distance from here over to here and make a projection. Let's see if I can do it. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 13, 36. So that's a point and 4/32 subtracted from this level. Can you read this price? No, the price.
It's 11.67 approximately, I'd say. Yeah, 11,600 approximately.
116 even?
Yeah, it's 11,600 even, I'd say approximately. Yeah. 11,650.
No, it's 116.28. And you take 1 and 4/32, 1.432 from there, and you get 115.24. I can't see exactly how low we got.
115.08, David.
Yeah, so it went further. But we could have made other point and figures as well, counts. But this was the beginning of my eyes opening to how the market worked. All right, let's go on. So in the 90s, I started writing a weekly report on the S&P 500. This chart is of the big contract. I'm not sure if this was still 500 or 250 a point. Probably 250 by 1999. And I've marked on here, if you've had a chance to read the text from this report, I write about how how many minutes or how many time periods are on this whole up wave here, and how much volume, and so on. It turns out on this chart that the heaviest volume of any up wave is on the last one. And yet, the amount of gain on that last up wave is much smaller than the amount of gain on this big up wave, or this up wave right here, and it's smaller than on this up wave right here. I mean, it's larger, excuse me. So this was a real indication, plus we have what's known and what Wyckoff called, and what Gary mentioned, shortening of the upward thrust. The distance from this high to this high to this high is shortening. This is a great tool for recognizing when a market is losing its momentum, when it's running out of steam on the upside or the downside. I look for this all the time on charts. You can look down here at the bottom, and if you draw a horizontal line, you can see that we have a spring here before the market went up. And this was a test of the spring, and so on. Well, this is how, in those days, in 1999, I made these charts by hand, and then I key punched this data into Metastock, and it was just close-only data for the wave. It doesn't show time or anything. Now watch. More. This is another bond chart, and you can see that we made a high here, and I showed the point and figure count. Notice this line here off of the first low that followed the high, and how the market came back to that. Notice the shortening of the thrust on this up wave to this up wave to that up wave, and notice the declining volume. We have a great deal of volume as we approach the line, and then on the next up wave, the volume is considerably less, telling us that there's a good chance that demand has run out of steam. And we're testing this breakdown over here to the left. This is where supply overcame demand. So the market has met resistance at this breakdown point. Any questions about this chart? All right. This is how I operated during the day when I made charts by hand, wave charts, not point figures. But I had this data sheet, and I showed every 1 minute. And I would draw a line under wherever a wave ended. The first wave on this chart ends at 10:29 in the morning. And there's a total, if you add it up, of 61 contracts traded on that decline. The next, that's an up wave. The next down wave only lasts 2 minutes. It's only 18 contracts. Then we go up 3 minutes, 22 contracts. And then the market breaks sharply, well, not sharply, but it drops about 6 points, 6 ticks, which is $180 some odd dollars, on 57 ticks. And then we have another big buying effort that takes us almost back to the high at 102 on 45 ticks. And so it goes until about 9:09, we have another sell-off, only a volume of 13, so there's no more selling pressure. And from that point at 9:09, the market rallies to 9:47. That's when we make the next high prior to having a correction. The correction began at 9:50 when you saw a 3/32 drop, closing price drop from 07 to 04. And you can work out the whole chart on this page, at least that much of it, and see it. That's what I did for years, is wrote all this data down. I didn't have it typed out at the time. It was all in handwriting. All right. Well, finally, I got this thing computerized. This is a chart of the Australian dollar futures. I'm using here, I think it's 3-minute closes, is that right? This up move during the day. This is the essence of what I'm doing. Right here, you see the market lift off, and we have good demand. And look at the shallow pullback. And this volume is in hundreds of contracts. So this pullback is single digits. Not much selling pressure, not much willingness to move lower. No, this is minutes. This is minutes per wave. This is the wave volume. So it was only 4 minutes going down. Then the market rallies on, I guess, 34 minutes. And very large volume associated with that. And then a very short reaction. Look how small the selling pressure is. Minute. And here is a change in behavior. Right here, the market goes up. The wave volume is much less than the previous 2 up waves, actually the previous 3. The thrust shortens, the distance from this high to this high to this high, and the duration is much less. All of that says that the market is running into trouble. It's tiring out. And if we draw a line across this earlier high, it's conceivable that this is an upthrust for this high. And then the market breaks. You have an increase in downtime and increase in down volume. It's larger down volume than on any of these previous down waves. So remember what Wyckoff said. In this case, the market's going down. When the duration of the down waves exceeds the duration of the previous down waves, and it has more volume, then you begin to know that the supply is overcoming the demand. And from there it goes on. All right. Now, this is a sugar chart, and this is a daily. And this wave is constructed so that the minimum fluctuation needed to reverse the wave line is 10 cents. So if the market closes at 26.53, it's got to have and it's going up, it's got to have a close at 26.43 or less. It may happen the next day, or it might take 3 days before it happens. And then it might start going up and continuing, 26.55, 58, 23.60, whatever. But here, I've drawn a horizontal line across the previous high. Look how much volume came in on the last upwave here. Very large. Several 100,000 contracts right here. And then a change in behavior on this downwave and then on this downwave. Look at how heavy the selling pressure is compared to what we had seen in February. We're over here in March now. So we've had a change in behavior. The sellers have gained the upper hand. But the market turns around, as typically occurs, for a test of the high. And we go up, and where I marked this first arrow, we have a little upthrust of this high. And on that volume, look at the force of the buying. You see how minuscule it is. There's no demand. signs that there's just a rally, and look at the force of the buying. It's very low. And the market's down from here, and look at the green up volume, the force of the buying throughout this downwave. It's very small. Volume is on the downside. Now I put the daily volume on this chart. Can you tell me, just looking at the daily volume, do you see anything here that lets you know that demand is spent? You cannot. This is one of the problems with daily data, or hourly data, or any data, but particularly daily data. Daily data looks like a line on the others, but by and large, it looks like this chart. It's hard to differentiate where the demand, where the supply appeared, where it dried up. I decided that price movement does not unfold in bundles of equal time periods. Price movement unfolds in buying and selling waves. You can chop up price movement into equal periods of time called days, and you can see the trend of the market. There's no doubt about it. But when you chop up volume, you lose something. You don't see how low the volume really was on this wave, or how much it was on this wave. You see what I mean? Any questions about that? All right. Now then. This is a weekly chart of U.S. steel. What's the message on this chart? Well, the first thing we see is that there's an up thrust on the left side back in 2010. If you drew a line across this high, and you can see that the market stabbed above it and then fell back to close on its low, and then down it went. And the first downwave drew out enormous selling pressure. And then it came down again, and the selling pressure began to dry up, so the market rallied and moved laterally in a tight pattern. And right here we have a small spring where we took out these lows, but failed to follow through. And there was not much selling pressure. You can look at the little red volume bars down here, particularly right here. You don't see any supply. The market's poised to go up. Now, I'm asking, what is happening up here in these weeks? What is the market doing? What is it going to do? Can anybody tell me? Anybody off the internet? You said go up. All right? Some people say it's distribution. All right, I wonder why they say it's distribution. But anyway, that's not far from wrong. It's just right. All right. Look, on this first downwave, it took about 4 weeks. Look how much selling appeared. That's the heaviest amount of downwave volume since over here. And then look at the next upwave. This is the heaviest up volume since way over here. And yet, as we've seen before, there's a great deal of effort and there's very little reward. So we know that someone is selling into this rally in a big way. And then the market sells off again, and the down volume is even larger. So we now have a picture here of a stock that's in big trouble. And you can look and see where U.S. Steel is now and how low it went down, I think into the 20s from this point. But it was all here on the weekly chart. Now obviously, trading the weekly chart does not give you as many trades as working with intraday graphics and reading these waves.
David, question. If you see something like that on a weekly chart, is it going to have a much bigger impact on the market than, say, a daily chart?
I think it will have a bigger impact on the market. I do. It may not be instantaneous because trades that develop on a weekly chart or a monthly chart take time to develop and unfold. All right.
Yeah. Can you just ask if there's any questions from the audience?
Any questions?
From anyone on the web?
Anyone on the web, let me know.
Give it a few seconds. What are the settings on your wave chart was the first question. The second one was, someone said a few weeks ago you showed a wave chart which actually had numbers on it, on the waves, for the number of contracts. Is there any reason it's not on this one?
All right, good questions.
Can you repeat the question? The first one said,
I know. The first question is, what is the wave size on this chart? It says at the top, 10-cent wave. In other words, I'm using 10-cent closing, weekly closing prices. And if there is a change of 10 cents or more, that can reverse the wave. If the market's going up and the last week closes 10 cents, the current week closes 10 cents below the close of the previous, the wave turns down. You know, I could use a 30-cent wave perhaps, but I rarely use any more than that unless it's a very expensive stock. Maybe Apple I use $1. Maybe Google I use 50 cents. Most of the time I use 10 cents, intraday, daily, and weekly. And the other question was,
the previous
the numbers.
Had the numbers on it.
Yeah, you can put the numbers, you can put the wave values, the wave volume numbers, and you'll see some as we go on, where the numbers are on the charts. But you see the volume in U.S. Steel is very large. And so if I start putting these large numbers, it gets in the way of reading the chart. And I really don't need those numbers. I know they're nice, they make it easier in some ways, but I never used them when I was doing this manually. I would make notes of how long a wave lasted, how many hours or minutes, but I never put the volume above it because I can read it right down here. But I'll show you charts where the volume numbers are above and below the wave turning points. And I know people like them. All right, anything else?
Nothing that I saw there. No.
All right, let's go on.
There was a question. On the S&P, they were using the 0.75 wave.
Right.
How do you figure out what is the proper range to different futures contracts?
Okay.
Does it have anything to do with the average trading range?
All right, the question is, how do I figure out what wave reversal to use with the different commodity markets or futures markets? And does it have anything to do with average daily range? Well, I don't use average daily range, but you certainly could. I just look at a chart, and it might be a hit and miss proposition at first. If you ask me to make a wave chart of rough rice futures, I don't think I know what to do because I'm not that familiar with rough rice. But if you ask me what to do with corn at current levels, I would use 1 cent. If corn's trading at $3, I'd probably use a 1/4 cent. So it's a function of volatility. And it can be a function of one's trading horizon. If you're looking at weekly charts, well, obviously you want to have something that will give you enough waves to read. You don't want to have just, I could change the wave on this chart so that we only have 6 or 7 waves. That would be useless. At the same time, I could drop it down to 3 cents, and we would have so many waves that you couldn't see the forest for the trees. So I'm constantly, not constantly, but when I first set up a chart, I might experiment a little bit until I get familiar with it. But I pretty well know. With stocks, it's 10 cents. With gold, it's 50 cents. With bonds, it's 3/32. With the 10-year note, it's 1/32. So half a 32nd with the 5-year note, and so on and so on. With silver, I think it used to be 0.05. With copper, it's 0.025. And these are all included in my trade setup file, recommended wave retrace levels. But as the markets change, we'll have to adjust those.
Another question?
Yeah.
Tom asks a question. The US Steel weekly chart. How do you know the stock is going down when the up and down volume waves are almost the same at the end of the move then?
Well,
can you repeat the question?
The question is, how do I know when the up on this chart, what is going to happen when the up and down volumes are about the same? Well, the first clue is all of the effort on this up wave without any reward. All we did is just slightly take out this previous high, and we couldn't hold it. So that's a big clue. That's an upthrust, and the market is not going to make it, that it's encountered selling. All right. Okay, here's a Forex chart.
Oh, actually, Goran's just asked a question on that. What are the meaning of the blue arrows? I think they're just there to highlight the card, aren't they?
They're just put in there by me. That does not come with the program, with the software. So this is a wave chart, 3 pips, made from hourly closes on the euro US dollar. And of course, you see the markets going up. What would have been a clue that the market was at or near an extremity when it hit this high? Any ideas? The clue was that look at the up volume. The up volume here is very large. The next up wave is here, and the next up wave is even less. So we see that demand is drying up as the market goes higher. And then we get a bearish change in behavior. Right here, the market goes down. Look how much selling is drawn out. I mean, that stands out like a sore thumb. Look on the hourly volume of the Forex. Can you tell that the volume on this down wave is so much greater than the previous volume? It doesn't show up. It's lost in time. Then the market comes down again, and there's almost as much down volume. And then here we have that typical reaction to test a high, making a slight new high with a lot of effort, just like on the US Steel Weekly, a lot of effort and barely any reward. All right, then the market starts working its way down unobtrusively, and then right here, selling emerges. And that's the beginning. That's when we start to break through this low, and you see the resulting downwave. And look at all of the selling. The force of the supply keeps overwhelming the force of the buy. All right. But I like to look at these charts with actual volume versus wave volume, because it's so much more informative, not with the wave volume, than it is with the actual volume. I can't reiterate it enough. Like right here, here's another example. One of the things people like to buy springs, but in a downtrend, buying springs is not a very good strategy. You draw a line under this low, you see we come underneath it with a lot of selling effort and not that much reward, and we go back up with some increase in volume, but it doesn't take out this high, and you have this outside downward reversal right here, and then the market is slammed down again. And this is the largest wave volume on the chart, and some of the largest hourly volume readings. So you've got a real good sense that it's getting to a crescendo here. Something climactic is happening. All right. All right, this is a chart of Goldman Sachs. This is a monthly chart with a 10-cent wave line drawn above the price and the volume below. Notice the character of the up wave up to the 07 high. As you all know, in 2007, the stock market made its last big high, and we had the horrendous down move of 08 and 09. And notice that on this last up wave, this is the October 07 high, and September and October, look at the size of the ranges, the price ranges. Look at, they all close near the high. Wyckoff referred to this as hypodermics, roofing up the price of the stock. Vertical price movement. More gain on this 2 months than we did in this 9 months or 8 months, or at least almost the same amount of gain, all in 2 months. But look at the volume. The wave volume is lower than the last 2 up waves. It's saying that this is on the one hand, we know that it's blow-off type behavior, but on the other hand, we know that someone has quit buying in a big way, or there would have been much more demand. And then here he shows his hand. Here's the supply over a period of 1, 2, 3, 4 months as the market breaks with a huge increase in selling. And then it tries to rally. And none of these rallies here, this one and this one, draw out any demand. If one is looking at this monthly chart, it's obvious there's only one thing left to do, and that's to go short and put a stop above this high right here. And down it goes, and we have this climactic action. And you see that this rally, with all of this effort in 09, did not get back to the high. It came back up into this zone here where the demand dried up, and it couldn't get through. We turned down, there was more selling. There was absolutely no demand here. More selling and no demand. Oh, look. And it's just been eroding. Now remember, the S&P in 2012 has taken out the 2011 high, but not Goldman Sachs, putting it in a much weaker technical position. Any questions? Anyone on the internet, any questions about this chart or anything I'm saying so far? This is highly repetitive. I teach a lot of traders. They come to me and they're interested, like I was when I first started, in knowing how to recognize a buying or selling opportunity. And the things that you saw demonstrated by Gary Dayton here this morning are a lot of the things that I showed him and that I've showed plenty of other traders over the years. It's the art of chart reading. And I certainly practice that art. It's an art that takes some years to develop. It's not something that comes automatic. You're weighing a lot of different factors. What I've seen with Trade Guide is that it provides a great ability to speed up the learning process because of all of the feedback that you get when these little errors appear. This text that describes the behavior. And if you read that text over and over again, you begin to understand it. I'm a strong believer in the ethic presented in the old saying. The old saying is that repetition is the mother of wisdom. If you've ever learned a musical instrument, if you've ever tried to learn a foreign language, if you've ever tried to learn how to read charts, it comes through repetition.
Absolutely.
The more you do this, the more you see convenient, certainly speeds up the learning curve in that it gives you these interpretations at each point. This kind of behavior is X or Y, potential X or Y, no absolutes.
David, I just want to add something if I can.
Yeah, go right ahead.
Just quick, I'll just come speak next to you for everyone. Tom Williams told me that that trading was reading the chart is a language. That's what he says. Which I hate. And the only way I learnt BSA was to read Tom's book 15 times. And I still read it today, even though I've written my own one. And really what I learned with charts, the best way to learn it is to repeat the same. Tom doesn't say anything different than he said in seminars 20 years ago. We've got people now that come to seminars from 20 years ago with Tom, and he says the same thing. And he said to me, Gavin, he said, I can't change it. I said, why? He said, because the market. I can't change the market. And he said, I'll be saying the same thing, you know, in another 10 years, we hope, touch wood. So that is important. Repetition is the way, isn't it?
Definitely is. I'm a strong believer in that. That was the first sentence I learned when I studied German. Wiederholen ist die Mutter der Weisheit. Repetition is the mother of wisdom. It's so true. All right. You won't move. What did you do when you came up here?
I just touched you, and that's it. So all you have to do is just click into the mouse thing and then hit it.
Oh. This is something that I've started doing recently. And intraday trading on a short-term basis, but I think Wyckoff would love it. Wyckoff traded for an average profit. Still looks favorable, I stay with the position. But I want to protect that profit as much as I can. This is a, what does it say? 100 tick bar chart. I think Gary mentioned these charts. It shows how many times, not how many times, excuse me, it shows how many trades occurred and at what prices in the last 100 price changes or ticks. And as I scrunch it all up like this chart is, and I'm really looking for pattern of behavior. I'm looking at the form of the behavior. I'm just looking for, and I'm using these lines as the structure of the market, the pattern of the market, whatever you want to call it. In other words, like right down here, this is U.S. Steel. The market has an upgrade. It pulls back. It jumps above this. It jumps above this high. And then it pulls back down again. And notice that there's very little volume on the test, pulling back to test this breakout. I have several places where I look for trades. I write about finding trades is like finding fish. I don't know if you ever fished in a freshwater pond or lake, but you can find trades in the middle. But the best place to catch a fish is around the edges of the lake, where the drop-offs are, where the sunken logs are, the points of the coves. Used to fish from a john boat with a cane pole and a cricket. I enjoyed it a great deal. None of this fancy fly fishing like Gary does. Anyway, these lines tell a story. Notice how this line was resistant. Market trying to go above it. It looked like we pulled back on top of the previous high. We pushed off. Here we met resistance. We pulled back on top of this high and pushed off. Not across there. The sell-off comes back between this high and this high. There's a lot of volume here. It's climactic. And then the market comes back up. Now look at this. This is a fascinating chart. This is one day on U.S. Steel. The market goes to up here at this point with a lot of the biggest volume on the chart up to that time. And again, a lot of effort and no reward. The potential upthrust. And then it turns down on this downward. Now look here. When it reached this low right here, the volume, what is that number? I can't read it. 500 and something? 548. Yeah, 548,000 shares up to that moment in this downwave. All right, over the next 71 minutes, is that what it says? So I've got a cataract on my eye. That's why I'm struggling to see. Anyway, over the next 71 minutes, the market is still in a downwave, and the downwall, but we're not going anywhere to speak of. It's just inching lower. So there's a lot of effort, and there's not much reward. All that lateral time here, all these minutes, this is a sign the market wants to try to go back up. Again above this high, and notice that the volume is a little less. And now the market I just say the sellers are overcoming the buyers. It's the same thing. The market is like an arm wrestling contest between the buyers and the sellers. And if we could attach electrodes to each arm, mine and my opponent's arm, and we had a screen, and we could keep up with blood pressure and all kinds of physiological factors, you would begin to see beforehand, who is gaining the upper hand. You can see right here, how many minutes is that? It's written there, I can't see it. How many? 28? 28 minutes right here without going up. What in the world is going on those 28 minutes? That we have volume bigger than on the previous two up waves. There's only one thing that's going on here. Selling. Big time selling. And look what happens. You see? What time are we here now? How much time?
20 minutes, but I'll do the question then. When selling comes into the market, stand next to you. The question is, when selling comes into the market, why does the market not just collapse instantly? Why does it appear to go sideways and almost drift up before suddenly coming off the cliff? What causes that?
Well, I'm not 100% sure why it doesn't just plunge right away, but I think one could argue, I know that Wyckoff would probably say, the large operator is sitting there trying to hold the market up with one hand so he can get off more shorts. That would be one interpretation. Otherwise, I don't know. You know, we talked about manipulation here. I've never had much experience with manipulation. I know it exists, but I had one experience. I used to write a market letter for the commodity brokerage company where I started working in the chart room. Later, I became the director of technical research, and I wrote the weekly market letter. And one day I got a phone call from a man, and he said, "Mr. Weis, I've been reading your market letter. I'm a counting customer, counting commodities. I've been reading your market letter, and I've had some very good trades based on your interpretation." He says, "I want to pay you back." I said, "Well, you can't send me any money." He said, "No, I'm the largest force in the lumber market." And he gave me his name, which I'm not going to repeat. He says, "I know what's happening in lumber, and I want to repay you. Go long lumber." And with that, he hung up. It was sort of like the Lone Ranger walked into my life. Go long lumber. And so I looked at the chart. It was not one that I dealt with. And lo and behold, everything on it looked like lumber was poised to go up. So I bought it. Why not? Of course I made money. I'm talking to the largest operator in the market. All right, let's see. What?
That proves this market's a rigged.
Well, I know they are. I know there's a lot going on that I don't know about, that I don't understand about, and I don't care about. All I care about is reading the chart and reading the message that it gives me.
There's just a comment. Brian just made a comment here, which I think is a good description of the market. He says he thinks the market's like a ship, a giant cruiser, that it actually goes in one direction. But if you're going to turn it, as unfortunately they found out in Italy, it doesn't turn on a dime. You're going to take a long time to turn it, and the Titanic the same. So basically, I think it's a good analogy. The market's built momentum. So as the momentum's in one direction, in order to change the direction of the big ship, they need to start selling. But even if they do it all at once, right, good, exactly true. Paul just said here live that basically what the smart money do is they hold the market up or churn the market, especially it happens at both ends actually. We were talking about this morning at breakfast. They hold the market, they churn it around until it's not, they churn the market, they hold it until it's not worth them doing that anymore, and then suddenly at that point there's no point in holding the market back. It's just a fall. It just collapses. You can see on that chart there. Yeah, good analogy.
Very good. Yeah. All right, this is an S&P chart. This is a 200 tick bar chart. Gary trades with a 9,000 tick bar chart. Works very well. This is 200. I would never look at a 200 tick bar chart. I just want to scrunch up the data. I don't want to look at those bars. I just want to look at the relationships on this chart as defined by the lines. The first line, the market goes up to this high and it backs off, so I draw a line across that high. It comes down to this low, I draw a line across this low. I'm doing this all day on my computer screen. Then I watch what happens when we come back up. Look at the force of the buying. I have an arrow down here. Look at the force of the buying on the last upwave. Does that tell us we should be buyers? Does that tell us the market's poised to go higher? I don't think so. It's a sign that there is no buying. And then we come back into here and try to go up again, and there's still no buying. And then it breaks down with a lot of selling. And it comes back down to this low, washes it out a little bit, and naturally the counter-trend traders run right back in and start buying. And this rally comes right back up to this first little low and can't get through. And we turn down again. And notice here, we're rallying up to these two lines. We're not able to go. There's a lot of effort, but we don't go. And then right here, we're starting to see some of the heaviest down volume on the chart. So right here, you know that we're running out of steam. You know that we're probably coming to the end. This dashed line is called a reverse trend line. Most important to know about. You can draw reverse trend lines off of highs or off of lows. In a downtrend, you normally draw a trend line off of one high and a succeeding lower high. But sometimes you can draw lines across a low and a succeeding lower low. And I denote that with a dashed line. And it to here, and to here. And look at these last three down waves. Look at the volumes there. That the selling pressure is spent and the market is ready to go up. One of my favorite quotes from Wyckoff is in his little book. In the market, just as in the life of an individual or of a business, which a feather's weight on either side will determine the outcome. This is just such a spot. I would write the letters MOR, moment of recognition, on the chart, on the handmade graph, to see, so I remember to look back at it. This is a moment of recognition. You can buy as many as you can hold. Contracts. All right. And then you see the first up wave off that low. Look at the amount of volume that comes in. Suddenly, all right. Well, this is a good place for me to stop. I'd like to do this study when we go back tomorrow. Is that all right, Doc? All right. I enjoyed it very much. Thank you.
Okay, everyone, what we're going to do, I've got a couple more things I want to show you on the VSE stuff, which will tie in nicely with that, so keep with me here. And what I'm going to do, the rising market. Now, this, in fact, was a quite wide spread on the bar, so it was what we call a buying climax, but it has the same effect on the market. It's going to fall. And what we're going to do tomorrow, I've got a lot of charts where we're going to go into specific detail on each of those particular setups. But I think what we've established already today is that, do you all agree, let me just ask one thing, that volume is absolutely vital in your analysis? Just put your hand up, yes or no, type into the internet. Do you all agree, do you think that volume analysis is key to being a professional trader? What do you think, Steve? If you said no, there'd be some trouble, wouldn't there? It is, and that's the key part. But do you know something? I'll say this again, 70 to 80 of the seminars I do to new people who haven't read books, who don't use volume. And I've asked Tom this, I said, why do you think that which you can teach anyone, really, and there it is. But as I'll show you shortly, that stochastics and MACDs are very misleading things. Because as the market's going up on high volume, they're all going to be telling you to buy because they're based on past price. They're not going to look at the volume. And that's half the trouble. This is my favorite setup of last year. Right? This is as beautiful as it gets. So the news comes out that Mr. Buffett is going to invest $5 billion in the Bank of America. Now, what happens the day before the news is leaked to CNBC and some of the other channels? They give us a tip. Buffett's getting in, everyone. This is a great time now. Bank of America's troubles are over. And so on that day, the next day, the market goes up from a low there, the close of $7, it reaches nearly $10. There are seeing a great opportunity to unload to the herd. What do you all notice about the volume there? Now, if that isn't Yao Ming, my name isn't Gavin Holmes. That is absolutely enormous. Sign of weakness 10 and 15, if you're a trade guide customer, are the two most powerful up thrusts because they're on mostly they're on high volume. I believe you can see up thrusts on low volume and high volume. The best ones are the ultra high volume like that. But they're especially better, and this setup works perfectly well because look, a few days later, the market maker is obviously here holding the price up. But look at what's happening to the volume. I mean, that doesn't get any more obvious. I mean, it's right in front of our eyes. Look. There's your up thrust. The mark is widespread, but it closes right there, look. Massive volume. Now, we talked about universal laws briefly. This is the law of effort versus result, and I'll give you an analogy that you can all relate to. How many of you know the program Deadliest Catch, where they go and catch crabs in the Bering Sea? Okay, some of you did. So, if we were to chart a crab boat and what was going on, this is what you chart. So they leave the dock, okay, they need to put the gas on, they get average volume, and so we see average. And everything's average until suddenly they're out in the sea there, and they, guys, right, let's unload these 100 pots at a £200 or £100 a pot, whatever they are. Well, the effort required to unload those pots, it takes about 18 hours for 100 pots, is enormous. So now we've got the volumes comes in. That's the first part. We see the effort for the fishermen as they try to get those pots in. We also see, because it's taken them 18 hours, in the spread of the bar here, the high and the low, that's the time it's taken them to unload the pots. Are you with me so far? This analogy okay, so we've got the effort is the volume, the spread of the bar is the timeline. Okay, they come back a few hours later, having let the pots soak. Now, what happens to the actual pots when they release them? Well, they catch 5 crab. Result is horrible. So for all that effort they've caught, now this actually happens. They have 100 pots, and I've seen them pull up 5 crap barrel, and you should see their faces. They're all smoking their cigarettes. They probably want to jump overboard at that point. And I must admit, there's things in life that disappoint me, but that would really disappoint me after 2 days' work. Now, in the markets, it works a very similar way. Everything is driven by effort versus result. And quite clearly here, we have exact effort versus result. But what encourages the traders that bought here to stay with the trade is it goes back up and they say, oh. David said the other day, a broker rings his client and says, look, he says, John, he said, I've got some good news, I've got some bad news. He said, what's the bad news? He said, well, you know, we bought Walmart at $90. Yeah? He said, it's trading at $40 right now. He said, oh my goodness. What's the good news? He said, it's going down on low volume. But when we see something like this, the market tanked. And then we always look for the opposing force to come back. So in order to buy it, we're looking for climactic action on any of these charts at the other end. So volume, obviously, we've said there, it's very, very important. Now, this is what I was talking about earlier. Numerous studies have shown that mutual funds overseen by professional stock pickers are outperformed by computer-driven indexes. The record for hedge funds hasn't been so impressive either. Since 2008, when the number of those funds hit 10,000, nearly 3,000 have gone out of business according to hedge fund research in Chicago. So even the smart money get it wrong. But this next statement is important. Richard, could I ask you a favour? Could you go and get them to bring some hot coffee out for us for 5 minutes' time, if you wouldn't mind? I think they know about it. The edge, says Richard Ferry, is hugely exaggerated. He's a member of advisory firm Portfolio Solutions and an advocate of low-cost index funds. This is important for all of you. Doesn't matter what size your account is either. If the small investor does the right thing, he or she can do better than 99% of anyone else. Wyckoff, in his day, was very similar to the people you're seeing up here. He traded the markets, understood the game, but he wanted to teach others or keep them out of trouble, really, and avoid the traps that are set. Most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what is popular and do well. What was popular in August last year? Gold. Most popular instrument, the most popular commodity. Oil. What have they both done? You can't buy what is popular and do well. And then the reason the markets work the way they do is because of human emotion. And Gary's an expert in this field. So Dr. Gary has helped a lot of our customers at Trade Guider who get stuck in this, I don't know where to go forward. I just don't know where to take a trade. They suffer from analysis paralysis, or their emotions are so powerful they can't trade, or they make terrible decisions. It's a problem, isn't it, Gary, for a lot of people. And a lot of traders don't recognize the market is driven by that. I like what Tom says here, though. The market has to be fed losers. It's devious, and what you will hear will often not be the truth. I've never heard the truth about the stock market or any market on television. Just look at the news about oil in May of 2008. Greed at the top. Gavin went on YouTube to show the end of a rising market, which we've discussed today a lot. Then look at the banking sector in 2008 during September. Fear setting. Professional money began to buy, not sell, and that caused stocks like Goldman Sachs, which we looked at with David, to rally 400% from that low. That's what happened. It was all in the chart if you know how to analyze supply and demand. So volume, as we've established, is activity. And it helps us as traders and investors to look for the footprint of the smart money. We have to called it the composite operator, yeah? A composite operator, simply put, is the consensus of opinion amongst all the big players. The spread and the close confirm it. So we'll leave you for the next few minutes on something I'm going to talk about at length tomorrow, the VSA sequential trades. Now, I've been asked about this so many times, and I've not really covered it in a seminar, so I wanted to cover it in this one. What is a sequential trade setup? Well, a sequence of events in anything in life starts with something that happens, anything, an activity, whatever. In trading, from a VSA point of view, the sequence starts with ultra-high volume. The higher, the better. Now, we're going to look, I tend to look back at 50, 100, then 200 bars. I have a system. I usually go back, and then I'll even jump out 500 or 1,000 bars. But I'm always looking at the back first. I start my analysis in the background. I project my lines out into the foreground. I'm not starting at the right edge and moving back. Most traders do exactly that, or they don't even look at the past, they just go at the right edge and see if there's a trade. I think, for me, I couldn't do that. I draw a horizontal line on the high, the low, and the close of the bar. I project the line out on the chart. Our software does it, most software does it. I watch then and observe as price returns to any of those three levels. I then look for ultra-high volume, or, just as importantly, very low volume at this level. It's very key to a trade setup. Here's a few examples just for you to look at tonight. So here's your Yao Ming bar, right here. Okay, now, as the market moves forward, this time I've used a trend channel. And as we hit the top of the trend channel, at the same level as the Yao Ming bar, we have a gotcha bar. This is the only time where you'll see a down bar with a red signal. Most down bars in Trade Guide are produce green signals. This one is a red one because of this in the background. It's marked down, and then there is an entry. Why? The sequence is ultra-high volume, widespread down bar on high volume, no demand bar. And they all happen, I don't know why, it seems to be within 25 bars. And I've tested that a lot. So you look for those in 25 bars, and it's especially powerful if you use it in more than one time frame, because guess what? If they're distributing on a 3-minute, they'll be doing it in a 5 and a 10 and a 15, and it will all start to make the chart roll over. Here's another example. We know here your weakness comes in. Now, again, the gotcha bar is a bar that I find very easy to see, and it has one characteristic, and this is important. Not every ultra-high volume down bar is a sign of strength. In this instance, we know what is the trend of price, everyone, behind us, up or down? You all agree that's an uptrend behind us. Anyone think that's down? Okay, good. What do we see on this bar right here? A weak bar. Well done. You immediately know, now that's an up bar, but you said it's a weak bar. It's a highest volume for more than 50 bars. Yeah? It's ultra high. It's a weak bar because it's gone up, it's tried to make a new high, and it's closed lower than the previous bar. Most traders that are breakout traders are buying there, and professional money know that. They buy because the MACD up here, the stochastic, everything is saying it's going up. Then we make a new high, we close higher than the previous bars. Now, if that was genuine strength, you'd expect to see some sort of test almost immediately and the market to stay sideways, but it doesn't. It reacts negatively, and then we get the gotcha bar. Now, why I love these bars is because these are the key levels. They take out all prior support, just like you saw in silver. It's manipulation. They do it deliberately. They catch all the longs and then go, now we've locked you into a bad trade. Now, at this point, if you haven't been stopped out, you're hoping and praying that the price is going to go back up. That's not a good philosophy for trading. Hope and prayer works in many places, I'm sure, but not for a trader. You have to then say, do I need to get out? But look at this. The market goes back up to the low of the gotcha bar. This does this all the time almost. Look at the volume. I've actually pointed it out on the chart. That is a setup. You see these in the E-minis. You see this is currencies. Sorry, this is a stock. I see these in currencies all the time on a 15-minute chart. How many people here trade Forex or currencies? Okay, Ken does. Just could you see how many people here trade currencies? Just from the internet, just let me know. Okay, we've got 5 more minutes, a few more minutes here. Look, I'll leave you with this one before, and I'm going to show you a lot more examples tomorrow. The flash crash. Okay, what do you notice about the volume that came in on the flash crash here? That is the flash crash at point A. Okay, now by the way, do we all know what caused the flash crash? No, it was a fat finger trader. No, don't you know? Oh no, the guy just accidentally was having a cup of coffee, worked for Citibank, and he pressed a B instead of an M. But there's no checks and balances upstairs, of course. And as he hit the B, the $1 billion order went through, and that's what caused it to fall. Oh yeah, that's right, exactly, yes. See, what no one ever explained to me, on the news they reported the futures market. But then you look at the stocks, Apple, Accenture, all the big ones, they all went to zero, well, Apple was just marked down. They all looked the same. Several large funds did that. And I'm not going to name them, doesn't matter. It was the flash crash. And it's widely known that no one has explained it. No one can explain why. Do you know, Richard, Facebook, we were going to buy Facebook shares, but fortunately we didn't, because the NASDAQ exchange mysteriously had a half-hour outage. I don't know how these things happen. Amazing. But not that I believe that. Anyway, we won't go there. But look at the top of the bar. This is deliberate buying going on. The market, though, doesn't respond immediately. It comes down for further buying, but this time the volume gets lighter and lighter. Now we make our first lower high. Okay, we make one here, but we make another one there. But we still haven't gone across the top of the highest volume bar, so I'm not interested in buying the S&P here. We don't even get there here. We bounce off the top of that. It acts as resistance twice. It even bounces off it. So that I'm not going to go long. But where I start to get very excited is there, 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 and there. Why? Because I've now moved above, and the supply has been removed from the market. That's why the S&P went and hit 1,430 or whatever it was. Forget the news. Forget what you hear. The flash crash was the start. That's it. What you see there is a weekly chart. And we know when we see these things, they don't disappear. And I promise you, they don't. So finally, what causes price to move on a chart? The past price does not cause the future price to move, despite what many traders are taught. The price movement is caused by the activity, either the buying or selling of the smart money. This cannot be seen by analysing the past price alone. It's vital to look at more than one time frame on any chart and to look very closely at volume, as we're going to see tomorrow. Okay, let's take a 10-minute break and let's come back here at 10 to 3 for Steve Phillips with his dulcet tones. So we've got Steve. So have a cup of coffee, have a cup of tea, and we'll be back here dead on time here at, let me just put the clock up, 10 to 3, so about 11 minutes time. Okay, everyone, I hope you all enjoyed it. Back with you shortly.